One of the big questions that's been debated here in Davos is whether the banks have put the financial crisis behind them and are on the march to recovery, or whether they're set to limp on for several more years, burdened by regulation, litigation, and all the baggage from those terrifying few months 5 years ago that nearly brought the world to its knees. And what I found talking to many of the world's top bankers the last couple of days here in Davos is that they do think that the industry has put much of the crisis behind it, but that it's emerging in a different shape. Structurally, there are some serious changes that have taken place in the industry. These, in investment banking in particular, the requirement for the banks to hold a lot more capital against several of their business activities means that they're getting out of those activities. And there is a concentration now among the top firms in investment banking where they're taking market share, and the weaker ones are having to get out of those businesses. So if I can just read you a quote from Anshu Jain, co-chief executive of Deutsche Bank, who said to the Financial Times in an interview, "You will wind up with a huge concentration in the market, with the dominant groups in each area having higher volumes and a more utility-like model with lower cost of goods and more transparency, but still representing a good return on capital." I think that sums up the sort of mood that I'm hearing here, in that, structurally big changes afoot in banking. It'll never be the same again, and hopefully it'll be safer. That's Martin Arnold, Financial Times, from Davos.